Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Thursday, September 25th, 2025. I'm your host, Dave Keller, coming to you from a beautifully sunny and nice and cool Redmond, Washington. I hope you guys are all doing well. Another bit of a distribution day for stocks today. Although the S&P did manage to hold the 6,600 level into the close, the damage was done right out of the open with a weaker open. Weaker first 15 minutes. Also, after lunch, we had another downside rotation and enough to push the major equity averages lower. Volatility increasing, not to warning levels yet, but certainly not remaining as low as it had been. Energy back at the top of the leaderboard. That's almost every day this week, I believe. Energy has been at the top of the list. I actually interviewed Mary Ellen McGonigal earlier today. About stocks and patterns and things like that for the Market Misbehavior podcast. Interviewed Frank Capillari earlier this week. That episode should be out actually right after the show. I just have one more thing I needed to do. That's why I'm a minute late. I was trying to just get it out before the show, but hey, had to hit the mark here at as close to 2 p.m. Pacific as possible. But overall, I would say a bit of a distribution day with some interesting leadership and also some interesting laggardship. We're going to see some of the strongest names struggling. Some of the breadth indicators continuing to deteriorate. Is this beginning of something a little weaker before the end of September? Does September become the awful seasonal month we've all expected? We'll see how many of those questions we can answer. May result in more questions, but let's look at the charts together and see what happened. As a reminder, we are live streaming on Facebook, LinkedIn, YouTube, and X as we review some of the market results today, as we review the heat map, and as we go through a bunch of charts. I'd welcome your questions at any point. Please keep your questions coming as a live participant. Would love to see your thoughts as we go, and I'll grab a question or two at the end of the episode. Any of the questions we don't get to, we'll go into our mailbag between some really thoughtful questions from you guys here recently and also our webcast earlier this week, which yielded some good questions. Should be a really fun episode, and I encourage you to tune in at some point over the weekend when time permits. All right, let's look at what happened today. So another down day for the major averages. I feel like, while the S&P's only been down like less than 1% every day, this feels like the biggest bear market in history after the sustained incline that we've experienced, right? This is I don't know exactly what behavioral bias I might call that. Maybe the recency bias, I guess, would be related. But, little moves seem a lot bigger when we've just been experiencing such a consistent uptrend for so long. So the S&P down about 0.5%, about the same for the NASDAQ, and not too much different for the Dow as well. All the major averages down, mid caps and small caps finishing lower. And again, no big 1% moves. And that was my interview with Frank Capillari. We talked about it, just the lack of days with a move over 1%. That's what the low volatility environment really represents. There's different ways we can measure volatility. We can use the VIX, which is actually looking at the options market, or we just can look at what percentage moves we experience on the S&P, right? What's the average swing? And it's just been pretty low, right? So if we ever have, at some point we're going to have a day where the S&P is down 1 or 2%. It's going to feel like the end of the world, right? You go back to March, April of this year for that kind of move. We just haven't had one in what 6 months or so. All right. What else on the front page here? VIX again still below 17, so we're still in a low volatility environment, but trending higher here through the course of the week. And I did an interview earlier today, the Financial Sense podcast with Jim Puplava. Should be out hopefully pretty soon, maybe early next week. Always love catching up with Jim on his podcast, and we were talking about what's sort of the warning sign, right? What's the chart or the thing that you would look for that would tell you, and that things are really starting to get ugly. And I sort of said, credit spreads widening, volatility increasing. We've really seen just little hints of either one of those, but nothing significant to the point that it feels pretty rough, but certainly something we'll keep an eye on. I think that may be the most important chart to watch, because that's the one that tells you when investors across different asset classes are starting to feel the pain here. Kind of mixed results here on the yield curve. You can see the 5-year point and 10-year points drifting higher. The long bond actually was slightly lower in yield terms. The TLT was basically flat for the day, no real change, and the dollar continued to push higher. That dollar chart may be another one to keep an eye on. We've had a weaker dollar environment for so long. That's been part of a number of different themes that we've tracked, particularly the outperformance of non-US markets. And a weaker dollar just makes non-US stocks seem much more valuable in terms of it's a great tailwind for their performance. Stronger dollar could change that quite a bit. And we'll see if that actually manifests. But we're really starting to see at least a bounce off major lows for the dollar index. We'll see if there's enough. This is the UUP, the $USD, which is the dollar index. On other platforms, it's DXY. I guess I could just show you, because as always, it's my show. So we're going to show what I want to show. Let's go to the chart of the dollar here briefly. There we go. Here's the dollar index. So the UUP is a dollar ETF, right? So it's a bullish dollar ETF, kind of tracks the performance of the dollar index, but it's an ETF, so pretty widely reported. So I like to start there. But the dollar index potentially making a double bottom here off the late June low and this low we experienced earlier this month in September. We're now back above the 50-day moving average. Above 100 would be this level right here. That would clear the highs from the end of July. And that, I think, would be, a big kind of rotation from a weaker dollar environment to a stronger dollar environment. Just all the things that, stood to do so well with a weaker dollar all of a sudden start to struggle potentially with a stronger dollar environment. All right, let's continue on with commodities. Another decent update for silver. The SLV was up 3%. Gold up as well, up under 0.5%, but continuing to push these uptrends. Gold miners really starting to explode to the upside, right? Charts like Newmont Mining and Kinross, KGC, Agnico Mines. These are all names that have had really good runs here, continuing to improve. That's been a trade we've been on for a while, particularly the GLD and IAU still hold a decent amount of those just because the charts, I think, tell you they deserve that. Crude oil bouncing higher as well, continue to bounce off with support. I would argue the chart of crude oil still isn't great, but it's not bad anymore. It's kind of okay at worst, and the energy sector is really thriving on this bounce in crude oil prices. Cryptocurrencies continuing to underwhelm. Bitcoin currently trading below 110,000. We're getting further and further away from those previous all-time highs around 125,000. Bitcoin today down over 3%. Ethereum prices down over 5%. You can see all the top 10 coins tracked on the stock charts platform in the red today. We did grab the chart of Bitcoin. We'll talk a little bit about specific levels here. This key level of support, I think we're getting pretty close to, and something to be aware of, particularly if you've been on the crypto bandwagon. Look at the 11 S&P sectors, and you can see why the breadth conditions today were pretty rough. Now, a number of ways we can measure breadth, which is basically measuring participation. We can do what I call sector breadth, which is just how many of the sectors were up or down. It is not a scientifically significant way of measuring it, but it's just a shorthand that has often helped me just get a sense of what's happening under the hood. The other one is look at more, broader measures of market breadth, percent of stocks above key moving averages, advanced decline data. We grabbed all those charts. We'll look at those here in a minute. All right, here you have the 11 S&P sectors. You can see energy, the only one that was in the green today, 0.9% to the upside. Everything else was down. I'll say that again. Everything else was down. So this is a distribution day. Healthcare at the bottom, down 1.7%. Consumer discretionary down 1.4%. The chart of Amazon is looking more and more like the worst chart in the Magnificent Seven, and I'll show you that in a little bit. The material sector down 1.3%. Again, after energy, you had technology and real estate and financials, which were down about 0.25% or less, but those are still losing ground here through the last session. So not a lot up, but again, energy continues to pop up, right? When I look for things that are working while other things are pulling back, I keep coming up with a bunch of energy names, and I think that's telling. It tells you something might be a shift here. All right, looking at breadth data, also not good. When you look at the advanced decline data, 72% of the New York Stock Exchange listings were down today, compared to 26% advancers. On the S&P, about a 3-to-1 ratio, 76 up, 24% down. pretty consistent readings across the board here. So this is bearish breadth, as way more stocks are down than we're up today. Our market trend model, we don't formally update that until Friday. So usually over the weekend, I will talk a bit about that market trend model with my market misbehavior premium members. It's kind of a foundational component to our weekly flight plan, which is the main report that I use to think about positioning and think about overall changing trends from one week to the next. If today was Friday and if we just close, my main market trend model would remain bullish, but the short-term model would actually turn bearish on the mid-cap stocks. This is kind of what you look for in this environment, is the short-term model turning bearish indicates at least a tactical pullback within the context of a long-term uptrend. That's what would signal first in a distribution phase that's going to be more sustained, and that's one of the warning signs we're looking at right now. All right, looking at the Magnificent Seven and Friends growth names, Apple up 1.8%. So on a day like today, names that were actually up, and Apple making a new all-time closing high, pretty noteworthy, I would say. Well, a lot of things in pullback mode. Apple is doing anything but. It's actually pushing higher. NVIDIA up 0.4%. Netflix up 0.4% as well. Neither of those are making new highs right about now, and I would say both of them more in a consolidation phase over the last month. But again, not down when the major benchmarks were. Tesla down over 4%. Now, this is coming off of an all-time closing high yesterday, so let's not get too negative just yet, but certainly a big distribution day. Meta continuing to pull back from its previous peak, around 1.5% lower. Broadcom getting back into the range of that gap higher that we talked about. That was back in at the beginning of September, just after Labor Day. One other thing I was going to show you. There is a really cool page on stock charts called, where is it? Market summary page. This is a page that has gone through a major, I wouldn't call it a facelift. It was more like a complete redesign earlier this year. I love the new capabilities. It really just is a great homepage to just understand everything that's kind of going on in the markets, looking at trend, breadth, momentum, sentiment, stock movements, leadership, laggardship. It's all kind of there in different forms. And there's this widget about halfway down the page called breadth. And if you switch it to moving averages, you can see the issue here. So this is looking at the major U.S. averages. This is the percent of index members above their 20-day moving average, the percent above their 50-day, 100-day, 200-day. So the further you get out here, these are some of the longer term measures, right? The S&P itself is way above its own 200-day moving average, not even close. So even with a significant drawdown, it would still be above the 200-day. And most stocks in the S&P are in that similar camp, right? 62% above their 200-day moving average. That's pretty good. But if you look at the percent of stocks above their 20-day, it's only 40%. When you go down to the mid-cap S&P 400, it's only 30%. So now you have a majority of index members in these major indexes, large cap, mid cap, small cap, back below short-term moving average support. And while that doesn't necessarily mean this is the top for 2025, and we're going to have a huge drawdown going into the fourth quarter, this is how one of those drawdowns would start, is the 20-day moving averages start to break, and then the 50-day, and then the 100-day. So if you see like a steady growth in red, like a horrible infection kind of building over the heat map, that would be the dangerous scenario here. It's an important table to watch, just to see if more and more indexes are seeing more and more negative readings on what I call these moving average breadth indicators. For now, it's the tactical breadth, the percent above their 200-day, really starting to get more negative with a lot of these major indexes. All right, we're going to go to the heat map next. As a reminder, I appreciate you guys tuning in live. I see some familiar names in here as usual, and welcome back, folks. Those of you that are new, thanks for watching live. The benefits of watching the show live, where you can ask questions all along the way. I'm keeping an eye on that chat. I can see comments on any of those platforms that we're live streaming on as we go. I'll take a question or two toward the end of the episode. And again, anything we don't get to, we'll put in the mailbag. And if you're watching the replay on our YouTube channel, just use the comment section on YouTube to include your questions. I'll read all of those questions and hand select some of those to talk through with you in a little more detail on Friday's episode. All right, here's a heat map, which is called the market carpet on stock charts. I mean, not great, right? I mean, not great. What stands out on a day like today, which was kind of neutral to negative, right? We see a lot of red, and we're going to get to some of those in a moment. But what immediately stands out to me is the stuff that was up today. And I think those are important charts to focus on, even just to review them, because anything that was up on a day when just kind of the averages were down and most things were down, things that were up, something's going on there, right? Something is different. There's some condition behind that chart that is suggesting there's an opportunity, right? It's not following the broader market lower. Continuing to show some strength. That's why Apple, I think, stands out among the mega cap names. It's really the only one having a significant update today, up over 1%. That's it. All the other names in sort of that mega cap growth space rotating lower. IBM, while not in the mega cap kind of top 10 list, is still a pretty decent sized company, as we know. That's also making a new swing high, continuing to push higher over 5%. Intel accelerating to the upside with talks about investments in the company and all of that. So handful of names in the technology sector, looking okay. In the financial sector, I'm intrigued by names like Charles Schwab, hopefully finding some sort of support and rotating higher. BlackRock, which is a name we've been writing about recently on CNBC Pro, for example, sort of resuming its uptrend, getting very, very close to a new all-time high above 1150 and change. And some of the exchanges and index data providers, market data providers, CME Group is one that stands out, up 1.6% today, bouncing off the support around 260. Financial sector is one of those that if growth continues to sort of rotate lower, right? If we see further deterioration, it's sort of that AI trade that has been lights out the top performing theme in 2025. To be honest with you, gold may be better. We can have that debate another day. They're both pretty good in 2025, but AI has certainly been the theme everyone's been thinking about. If they start to rotate down, the question is what emerges in a position of strength. And things that would come to mind would be financials, which have just been strong charts and are not showing as much weakness, and actually have already pulled back, like a CME Group that's getting ready to rotate lower. There's others like JP Morgan, which pretty much at new all-time highs this week. So there's still quite a bit of strength in some of those, sort of money center banks. Industrials, particularly like, aerospace defense stocks. A lot of these were down today, but the trends overall have been remarkably strong. These are the types of companies that if there's a big government shutdown, aerospace defense, probably not impacted by that so much. I mean, those would be names that I would think would do pretty well. And then energy, right? I mean, these are the charts from a bottom up. Those are the charts that are starting to improve the most by my read. Other things that stand out besides the bright red on Tesla and Oracle, and I would say both of those charts pulling back significantly this week. I would say, in both cases, you really want to think of a key line in the sand and make sure that holds. But the pullback in Oracle concerns me a bit because it's looking a lot like kind of a double top pattern there, around 3.25. But the other one would be in healthcare, right? We've been talking about the potential for healthcare names like Merck breaking to new 3-month highs, but then just completely pushing to the downside. We've talked about names like Eli Lilly rallying off of an August low, but now rotating lower this week. Talking about biotech names like Gilead and others now starting to make lower highs. So the healthcare sector, I mean, promising, but now starting to look a lot less so. There are random names in there still doing quite well, like a Johnson & Johnson, still very close to previous all-time highs. But the average name in that sector, including in particular S&P names, struggling a bit here. Those are some takeaways talking about the heat map. Let's get to some charts, shall we? The chart of the S&P 500 as of today, testing its 21-day exponential moving average. You can see on my daily chart of the S&P 500, we have the 21-day EMA in green, the 50-day simple moving average in blue, the 200-day simple moving average in red. So what's happened is we've pulled back to the 21-day exponential moving average. That's actually happened 1, 2, 3, maybe we'll call that 4, 5, maybe we'll call that 6, 7 times since the initial breakout in April, right? This is why the 21-day EMA for me has become a sort of tried and true initial line in the sand. The 50-day moving average for me is kind of the point of no return. We break below the 50-day and I'm probably starting to change positioning in some way, but breaking below the 21-day is that's like where the alarm goes off, right? Think about it like when you get your alarm in the morning. I use my phone. the initial alarm goes off. That's breaking the 21-day. I'm very comfortable going back to sleep at that moment, though, and I often do. But you finally get up, the alarm finally goes off. You can't hit snooze anymore. For me, it's my wife saying, "Honey, get out of bed." That's breaking the 50-day. That's when you have to take action, right? I can't say no at that point. I am no longer able to hit snooze. That means I got to go somewhere. And so, we're sort of at that initial warning sign here with the S&P testing the 21-day exponential moving average. Now, again, that's happened a bunch of times since originally breaking above there back at in the middle of April. And these previous times, it's been pretty good tactical pullback points. But the question is it more significant, right? Is this a time that's different? And I would say what would make this different would be a break of the 50-day. That's something we've not seen. We've not seen a downside break of the 50-day since the February 2025 peak, right? You got to go back there to when we broke through the 50-day. And since that point, we've broken above it and stayed well above it. So that would, in terms of things that would tell me it's a change of character, that would be it. We highlighted for our market misbehavior premium members in our weekly flight plan over the weekend. Look, the S&P's overbought. That means two things. That means, number one, conditions are pretty good, and the trend is pretty positive in the fact that we've gone up so much that the S&P 500 is overbought. That also probably means next week is going to be a rough one, at least some sort of pullback, because we're going to come out of overbought conditions and at least stall out in terms of time or price or both. And so I'm not surprised to see the deterioration. We highlighted on Tuesday's show the bearish Harami pattern on the S&P, which tells you the next 1 to 3 bars are lower. So kind of these classic technical analysis tools, I would argue, still work beautifully in 2025. Paying attention to when an index is overbought, thinking of the tactical implications of that condition, still valuable. Candle patterns and how they tell you short-term changes in sentiment from bullish to bearish, serving me quite well here this week and in previous weeks as well. Here's that candle pattern that we talked about, that bearish Harami pattern. And again, I don't use candle charts as a primary tool, but when I notice a pattern is emerging, I pay attention. And it's a shorter term gauge. I'm a little more of a medium term / longer term investor, more of a position trader than a swing trader. But understanding those swings and understanding how that should impact your trading from one day to the next, I found is important to pay attention to. So the short-term pullback is pretty important. As we said, we're at the 21-day. I'm not showing that here, but we're right at the 21-day moving average. We're kind of right at this very similar candle here. This was the last Wednesday before we jumped higher to finish the week strong. Hey, maybe we get another one of those. I don't know. All right, looking at some breadth indicators. I was actually just finishing up an article for stockcharts.com talking about some breadth indicators. This is one of the charts we'll highlight in that article. But I would say with the S&P 500, remember, moving average breadth is how we look at all the members of that index and just think about how many of them are above key moving averages. What this chart is telling you is, as of today's close, 62% of the S&P 500 members are above their 50-day. Only 50% are above, 62% are above their 200-day moving average. That's a longer term measure of moving average breadth. 50-50 as of today's close as to whether a member of the S&P is above or below its 50-day moving average. It was actually earlier in the day. I think it was slightly below there when I checked earlier. It was around 49.8 or something, but at the close, just above 50% as of the latest data. So that on its own is not the end of the world, but breaking below 50% would certainly not be good. That is one of those kind of basic litmus tests I like to consider. If over 50% of the S&P are above their 50-day moving average, things are still pretty good. But if we break below 50%, that tells me we're in a condition that often happens, right around major market tops. What's more concerning on this chart is if you start at the end of June, think about what the S&P itself has done, right? We've been making new highs every month since, pretty much since April. And if you look at this indicator, we made a new high at the end of June, but then from there, every new high has been marked by less and less S&P members above their 50-day. So the index is still going up. It's still trending higher, but more and more stocks have already broken down to the point that they've broken down through their own 50-day moving average. So we talk a lot about, can the S&P hold its 50-day? That would be good if it could. The problem is most stocks, it looks like, are starting to actually break below their own 50-day moving average. That is not a great vibe. That is not a great condition. Not necessarily the most perfect timing tool I've ever used, but it definitely speaks to the sentiment. And again, at major tops, and that's a decline, a divergence that you often have. Advanced decline data getting less and less good by the day here. You can see my very unscientific but subjective color coding system. Green's bullish, orange is neutral, and red is bearish. And you can see as of today's close, I have color coded the mid cap advanced decline line bearish because it undercut the low from the end of July. The small cap and large cap and New York Stock Exchange broad universe advanced decline line still above their low from the end of July. But all four of these finished the day below their 50-day moving average. Even the S&P 500's breadth is starting to weaken here a little bit. So one by one, these measures of breadth trend, right, which is looking at the breadth conditions and how they're changing by looking at the daily advanced decline data all weaker. And this isn't actually updated for today's close yet. This is through Wednesday's close. When today's readings get on there, you will find more of these continuing to accelerate to the downside, I would argue. All right, let's talk about Bitcoin. Not a great day today. One of the biggest distribution days we've seen, I mean, arguably since some of these big down days that we saw last month in August. Back below the 50-day moving average, which is not great. We're getting close to this purple shaded area. This is a kind of pivot point. It's really more of a range that I've been thinking about. Basically, this range encompasses a couple things, right? I originally sort of followed this level back here at the end of last year. This was the December peak around 108,000 and change. We double topped there in January of 2025. And then big retracement, about 61.8% of the previous uptrend to an April low. We then round tripped back to that previous high, overshot it a bit up to around 112,000, pulled back a little bit, and then finally broke out, right? We had this bull flag pattern that resolved to the upside. Now we made a new all-time high around 125,000, and now we've come back to that breakout level, which is now support, and it served as support at the end of August. Now we're right back to that point. So I'm thinking of this range from like 105, 104.50 to 107, 108. That's the purple shaded area that you see here. It's also a 38.2% retracement of the way back down to the April low. The 200-day moving average is right at that level as well. So for me, that is like the level, right? Is if we hold above that, I think Bitcoin is good. I will likely, remain in the position that I have with Bitcoin. We break below that level, and I would start to unwind things for the risk of having a much further deterioration like we experienced in Q1. Right now, we're kind of right back here. You can see here where we break down through established support, and that's when it turns into a much more significant decline. And this is a pretty big move because Bitcoin is a fairly volatile asset. So, we're kind of getting into that point where if this is still a bullish chart, this is about where we should find some stability. And that's why I thought it was really encouraging at the end of August that we found support there. Now that we're rotating back, I think once again, this becomes an important area. I think this chart and that range highlighted in purple, pretty valuable. RSI drifting below 40 this week, which is also not making me feel great about that particular chart. All right, some individual stocks to consider. I'll take a question or two and we'll be done. Here's the chart of Broadcom. As you can see, still holding its 50-day moving average. We last tested the 50-day back here at the end of August. Had a nice bounce around Labor Day, which pushed us up just above 370. From there, we've actually pulled back, and we're right at the upper end of this gap. I usually have gaps on the chart as like a shaded area. I'll show you what I do. If you're a stock charts person, if you go to annotate, make a rectangle and pick like a really light color, and then just kind of draw the rectangle. That's what I like to do. And this is a trick I learned from Arthur Hill, who's a longtime stock charts contributor and team member. That's kind of what you do. And then we save it. And the way you do that color, by the way, I meant to show you. If you go here, you can actually make these boxes like more or less transparent. So I just take the transparency way up, or just make it a much lighter see-through kind of color. And then you kind of have this range, and you can follow where the price is relative to that range. That's what I did on that chart of Bitcoin before. So overall, I would say we're right at that point. Again, we're right at the gap level, which for me, I tend to think pretty simplistically about gaps. I just think of them as support or resistance ranges. I think of that as an important level where you're probably going to find some future support. And so this is kind of where we would expect some support to start to be created. The 50-day moving average is right in that range as well. So I think this is crucial, right? We hold this, and Broadcom is still a pretty good chart. We break 310, and Broadcom is a really ugly chart very quickly. I'm jotting that down so I don't forget to set that alert. I don't remember if I have that one yet. All right, we continue on here. There's Broadcom. Someone actually asked in the chat about Amazon. Luckily, I had grabbed that chart. Amazon is a fascinating one. There's a bunch of different things to talk about here, but my quick way of summarizing it is I think looking back toward the end of the year, we're going to think of this as a pivotal moment, right? We have this, what's called a symmetrical triangle or coil pattern. Tesla had a pattern very similar to this. And the idea with a coil pattern, it is a market in equilibrium. It's a triangle where the lows are getting higher and the highs are getting lower. We're kind of narrowing into this equilibrium price. Buyers and sellers are kind of in balance. They're in agreement, and we're just kind of fluctuating around that price. And what you look for is a break out of that pattern to the upside or the downside. And if you look, we actually resolved this pattern to the upside. And I remember doing the show on that day and thinking, this is a great chart and this is a great breakout, breaking out of this coil pattern. That suggests much further upside for Amazon. The immediate next day, we had that bearish Harami pattern we just saw recently this week with the S&P 500. We did end up going higher for about a day or two before we went right back into the range, and then we've just stalled out. So basically, we failed to clear that previous swing high, right? So we have a coil pattern like this. The initial signal is a breakout of that pattern. Then you really want to get follow through above that, the beginning of the pattern, because that really shows we're to a new 3-month high, which for me is pretty meaningful. Never really got the follow through. And now all of a sudden we're in a distribution pattern. And now we're back down to the 200-day moving average. So for me, the signal to lighten up has already been hit with the break below the 50-day. Break below the 200-day is, I go look at something else for a while and find other charts that are not below their 200-day moving average. That's how I think of it. So very close to, I would argue, a point of no return on the chart of Amazon. Momentum getting weaker too, which is a big concern. Out of the Magnificent Seven names, I would argue Amazon's the worst of that bunch at this particular moment, given that distribution that we've seen this week and the failed breakout. All right, little shout out to underperforming Pacific Northwest companies. Unfortunately, 3 I'll highlight for you. Starbucks, based here in Seattle, Washington. Not a good chart. They obviously just came out with announcement that they're closing a bunch of stores and letting go a number of workers as a result. What happened today, it's kind of a shorter term pattern, but you can see this, what's called a bear flag pattern. That's where you have a downtrend, and then you have an uptrend, a shorter time frame uptrend of higher highs and higher lows. A break below that pattern basically implies that the move going into that flag probably mirrors the move coming out of that pattern to the downside. It suggests much further deterioration, at least back to the April lows. That's what that pattern would suggest on its surface. This bull flag also stalled out right at the 21-day EMA, similar to what we saw here at the end of August, before a new swing low coming in the next week, or at least the new downward leg coming almost immediately. So I would say Starbucks now clearly in a period of distribution. The RSI consistently below 50 in September, now below moving averages, which are all trending lower. And this I would probably label as a bear flag, which suggests further downside deterioration. Nike, actually based in the Portland, Oregon area, not too far from here, and in the same general region, but also struggling. Nike is one of those testing its 200-day moving average. And again, as we've discussed on other charts, holding the 200-day is pretty important in my work because I kind of follow the Paul Tudor Jones maxim. Nothing good happens below the 200-day moving average. If you want to avoid having climactic losses in your portfolio, just stop holding things that go below their 200-day moving average, because that can often be just a little thing, and then it'll get back above the 200-day. Then you can think about it again. But breaks to much further losses, right? 90% losses. You get through the 200-day pretty early on in that a lot of times, and so for me, this is a pretty important level because below there, it's not the kind of thing I'm generally going to be looking at. I would say also this makes this a pretty clear double top at the end of July and end of August, breaking below the moving averages. The 200 days, the last one there. But for me, it's already done enough damage. The momentum has deteriorated to the point that I would say Nike is no longer a great chart. Finally, Boeing, obviously one of the biggest employers here in Seattle outside of Microsoft and Amazon and others like that. But Boeing, again, having a series of tests of that July peak, right? July, we peaked just over 240 on a closing basis. It was more about 236-ish. And you can see we retested that level a couple times in August, and the beginning of September to now has been a deterioration below the 21-day, below the 50-day, still well above the 200-day moving average, but we're breaking, lower highs, lower lows, momentum more negative, right? Which the RSI pushing below 40. So this is the type of chart that seems less compelling. In this kind of environment, right, breaking back above the 50-day moving average can also be often be a signal of a nice improvement. The other thing I would look at on the chart of Boeing while we're here is switch gears to something like MACD or PPO. Here's the MACD indicator, or the PPO indicator, sort of a bottom fishing indicator. It's designed to help you recognize when a bottom is in, and we're starting to see accumulation off of those lows. We're not quite there to that bullish crossover, but in this kind of environment, if I'm kind of on the fence with something and I'm not sure I want to be, taking a position, waiting for something like the MACD indicator, or PPO is what we're looking at here, which is very similar. That bullish crossover could be a nice indication of accumulation. Not quite there yet. It's more stalled out, and we're in wait and see mode. All right, we'll take a question or two. I do want to thank Tony, a longtime watcher and frequent participant in the chat. I did not acknowledge yesterday his super chat. Very nice contribution on our YouTube channel. I appreciate that so much. As always, thank you for watching, Tony, and thanks for supporting Market Misbehavior. Much appreciated, and I thank you for that. All right, shall we take a question or two? Yeah, Bull Bear Jeff, you answered your question, but this is one that I know a lot of people often get to. What's the symbol for that bottom chart? And it's back here when I was showing this guy, the percent of stocks above their moving averages. So the Stock Charts platform has a rich database of breadth indicators. I'm hopeful that at some point, not too far off, there is a breadth homepage that is on the Stock Charts platform. I'm hearing some rumblings that might be coming here later this year, and I am hopeful that that's the case. But the tickers for these breadth indicators can be challenging. And to be honest, if you use other platforms, one of the problems with charting platforms, I guess one of the challenges, there's no like formal best practices or accepted process for tickerizing breadth data. So every platform, it's kind of up to them in terms of what tickers they want to use for stocks above their moving averages or an advanced decline line. It's sort of the Wild West. There's no like lunch where they all get together and talk about what to do. And I know that from having worked for a number of market data providers and used a ton of their platforms, it's all different. So part of learning a new charting platform is just figuring out, besides like ETFs and stocks, which have an exchange which sets their tickers, things like breadth data and indexes can actually have very different symbols depending on what platform you use. So the best thing I found is find someone else that uses the platform, see what charts they like, and then and that you think are helpful, and then ask them what the tickers are. And that's served me very, very well. And I would encourage you to do that. Anything I show on the channel here, I'm happy to show what I'm doing. These are the tickers for the S&P stocks above key moving averages. And if you figure out the syntax there, $, the index ticker A200R basically means above the 200-day moving average. You can do that for some other indexes as well. Best way to find breadth data is use the autocomplete. Just try to type in the symbol. It's not perfect, and it can be challenging with breadth data, which is pretty crazy. The other thing is on that market summary page that I showed you. So on Stock Charts, go to Market Analysis, Market Summary, and all of these charts are tickerized. So like if we go down here to moving averages and you click on S&P, it's going to bring up a chart that has a series of each of those, and you can find the tickers there at the bottom. So those are actually hand selected, kind of like the indicators you probably want and the charts you probably, the breadth indicators that are most common are all on this page. That's a great way to find some of those tickers if you're struggling to do so. Thanks for that question, though. I appreciate it. All right, one more question, and then we'll call it a day here. It's questions about Stock Charts Day, which I'm I'm happy to do it. I know the platform pretty well. I use it often. Dave, what do you think about using the sample scan library on stock charts, especially using candlestick patterns, uptrend plus engulfed, and then run the scan? Cardinal Health, which you chose, came up. Yeah, 3P Investor, thanks as always for watching. I'm a huge fan of it, selfishly because I contributed some of the scans. So I like the ones that I threw in there because they're ones that I use all the time. And a number of months, actually over a year ago, Grace and Rose came to my office and said, "Hey, we're putting this sample scan library. What do you do that we could put on here?" And so I threw some of the ones up there. One of them is down at the bottom. We did some from the experts. So I did strong scooter rankings in the technology sectors, like basically looking for combining like a sector play with stocks showing good relative strength is what I was looking at. And we encourage you to check out some of those other ones. Grayson contributed a bunch of really interesting ones as well. This is a great place to just get ideas. And I would always say, remember, you start with these, right? If you think bullish engulfing patterns are interesting, run the scan and just see what some of the charts look like, and then edit the scan, and then you can make it more custom to what you're doing. So a lot of times, like I'll edit one of these scans and say, all right, let me only look at S&P 500 stocks, so I know it's a list of manageable companies that I know that are pretty liquid. Or maybe I want to combine it with some other, things that I like to incorporate into scans, and you can do that. So I'm a huge fan of using this. And other platforms have kind of sample scans to go through. I think it's great. It's just kind of getting the juices flowing and just thinking about what makes sense. And I will tell you, these scans on here are ones that either the expert network that is part of stock charts like me and others, these are things that we use often. Or it's things that we found our users are often trying to scan for, like new highs for different time periods. Super helpful. And the one that I would strongly encourage you to explore, new 3-month highs and new 3-month lows. That's one that I use all the time. I run that a couple times a week on different indexes and different groups just to understand what's working and what's not. And if you don't want to miss the next awesome thing, the next big breakout, the next stock pushing above resistance, that's a good way to do it. But to your point, I think the question that you asked was a valid one. Just remember, these are just ideas. Combine some of them in very powerful ways, right? Bullish engulfing patterns, then showing some strong volume characteristics. RSI oversold, and then a MACD buy signal. Like there's ways you can combine different techniques to try to identify things that are starting to show particular characteristics. But for sure, and the candle scans in particular, I think are just fantastic to identify some of those stocks showing a change of character in the short term. That'll do it for today, folks. Thank you so much for watching every day. Thanks so much for those of you tuning in live, keeping it dynamic and interesting. Those of you watching the replay on our YouTube channel, please share your questions as you go in the comment section. We're planning an all mailbag episode tomorrow. Also, don't forget the latest episodes of the Market Misbehavior podcast. My interview with Frank Capillari of Cap Thesis should be out momentarily. My interview with Mary Ellen McGonigal, hopefully very soon as well. And for tonight, I'll say have an awesome night. And remember, it's always a good time to own good charts. Take care, folks.